Hello, I'm Victor Adair, and I'm here on behalf of HowStreet.com. We're in Vancouver. It's the second week of June 2009, and our guest right now is my longtime friend, Paul Van Eeden. Paul, thank you for taking the time to visit with us.
Thank you, Victor.
You, over the past couple of years, we've been at seminars together. I've heard you talk different views you've had on the market. I know one of the things, going back, it's got to be more than 6 months ago, you were focused on, you thought the bond market, yields on bonds, were going to rise. I think you were probably surprised that they fell as low as they did toward the end of last year, but they've really had a sharp rise since then. Give us your thoughts about that. What's going on?
Well, first of all, you're right in that I was surprised at how far they fell.
Yeah.
But I also think that the rise in the yields since then is indicative of what is to come. Mm-hmm. Now, I'm not trying to make a short-term prediction here. I suspect that the yields in the near term can again fall because I think that the equity rally is a sucker's rally, and I think that there's a lot more economic woes that lie ahead, and therefore I don't necessarily anticipate bond yields to be rising substantially over the next, say, 6 to 18 months. But over the course of time, I expect bond yields to rise significantly. That is because the supply of bonds that are going to come onto the market due to the government deficit is going to dwarf and overwhelm the fear that people have of equities, and therefore the desire that they have for holding bonds at the moment.
So if we have a scenario, we picture this going forward, where you have a terrific supply of bonds coming out of the market that pushes price down, pushes the yield up, what does that do to the rest of the world?
Well, it is a fact that the rest of the world's markets are all linked. And I shouldn't say the rest of the world's markets, all the world's markets are linked. So when the United States interest rates rise, it puts upward pressure on other interest rates as well. Because of the economic downturn, it may be that the absolute direct link between, say, US interest rates and European or US and Australian may be a slightly weaker, but that link will nonetheless exist. So I suspect that interest rates across the board are going to go higher.
If we've got interest rates rising, then it would seem like, and you refer to it as a sucker's rally in the stock market, that might be one more reason where if you've been taking advantage of this spring rally that we've had, you might want to loosen up. I don't want to put words in your mouth. What do you think about that?
Well, I agree with that. You know, I've been trying to be short the bond market and captured some of the decline in the bond market that we've seen in the past few months. And I'm basically out of that trade, which is almost the same as saying if you've been capturing the gain in the equity markets, I'd be out of that trade as well right now. And that doesn't mean to imply that the run in the equity is over, but I do mean to imply that I think it's getting long in the tooth, and I suspect that there's going to be a higher probability of a decline in equity, significant decline in equities, rather than a significant rise in equities over the next 6 to 12 months.
So the bigger risk then is maybe another leg lower rather than the risk being that you miss out by not being in the stocks at this point.
Yes, I guess that is what I'm saying, but there's another point to keep in mind. I will always swap missing an opportunity for missing my money. What I'm trying to say is I will always try and mitigate my risk rather than to try and capture the last money on the table. So I don't really care if the equity markets rise and I'm not a part of it, instead of not having to take the risk that the equity markets fall and I am a part of it.
You know, Paul, I think over the years I've mostly known you from your models that you did on gold. You're trying to determine what you felt was a fair value on gold. I know we've got like a minute here, but what do you think about the gold market here at around $950 US?
The macroeconomic environment has probably never in history been as favorable for gold as it is now. Everything that you could script and imagine to put gold in a positive light is currently there. My belief, however, is that that is already priced into gold by the market. In my opinion, the fair value of gold for 2009 on an average is about $815 an ounce. Now understand, that is not a price prediction, that is a value statement. I think that's what gold is worth. What gold is going to trade at depends on the market psychology. However, with gold at 950 or more, which means it's about 20% overpriced, I suspect that a lot of the good news for gold is in the price already. I am therefore not very bullish on gold at the moment.
Paul Van Eeden, as I say, a longtime friend of mine. Paul, thank you very much for taking the time to visit with us here. We're in Vancouver the second week of June 2009. This is Victor Adair and Paul Van Eeden for HoweStreet.com. Thank you very much for watching.
Comments made on Howe Street Video and HoweStreet.com are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at HoweStreet.com. Howe Street Video is a production of Howe Street Media Incorporated.